Hello, everyone. Let me know if you can hear me. Super, super. Okay. So, thank you for coming by and for the second part of supply and demand advanced trading concepts. Um, Let me know if you were here last week, so we know that you're um, okay. Okay, I see people were here last time, so but for those who didn't, we'll do a very fast recap on what is the supply and demand theory, and then we dive in. I see most people were here last time, so we'll do a fast recap. Um, but I think it's pretty much self-explanatory, so if you don't get it right away, you'll get it through everything that we're going to discuss today. There's so much here to cover today, so let's just start moving on. So, what we're going to talk today, um, we're going to do a recap about supply and demand theory. We will do some recap on how to mark and how to accurately find these supply and demand zones. Then we're going to discuss on a very interesting topic, which not, I think, most technical analysis systems do not provide this answer for why a level is going to hold and why a level is in potential to be broken. This is something that many simplified um, technical analysis theories don't really cover, and supply and demand based on order flow understanding provide these answers in good certainty. Nothing is 100% proof, but we will have the thumb rules to know how we are going to manage risk upon this type of analysis. So today I have a few more illustrations on how to understand the order flow reading on the chart. It's going to be interesting, so follow me. We have to pay some rent, so here's some commercial and we'll do it fast and continue. My name is Gil Ben Hur. I'm trading for 14 years. I'm an independent trader. I do manage private portfolio for private clientele, for family, for myself. I used to have to be a partner in a very big trading community with a premium trading education program. In the past 4 years, I'm the founder and CEO of the 5percenters.com, which is a funding, traders, and growth program. Whoever is interested to be a funded Forex trader is welcome to visit our website and see the terms and see what the program is all about. If you read their website and you have some questions, we have a good, friendly, dedicated support team behind chat, emails, and telephone. So don't be shy to ask questions. Let's move on. So a fast recap. What is supply and demand? What is order flow? It's everything based on the very, very core essence of what makes a market. Trade is when two sides agree upon quantity and price. This is what happened everywhere. Every time you negotiate of buying or selling anything, if it's selling your old car, if it's buying a house, if it's buying bananas at the market, if it's buying stocks at the stock market, it's always about offering some price for a commodity, and you say how much you want, you say how much you're willing to pay. If you find a seller to sell you, then we have a deal, right? So this is the very core essence of any market, including financial markets. So supply and demand is what defines the balance between these people that are coming with the intention to buy a supply, to buy a commodity, to buy the stock that is being sold, and between the supply side, which are the sellers, representing the sellers, the people that are already holding the asset and they are willing to sell. So now they're coming at the market through the exchange or through the platform and offering what they want to do. They are setting their orders for what they want to do. If there are sellers, they say, okay, I have this much quantity I want to sell. If I'm a buyer, I would say this, I want to buy this quantity at this certain price. If we find a match, there is a deal. Okay, so everything boils up to the big numbers, to the masses. How many people or how many participants or how many orders are there at the desk of the exchange that willing to find a match from the opposite side. So as long as we have enough buyers and enough sellers, price will stay at a certain range. This is what we call a balance or a base area where price and quantity is fully fulfilled for both sides. So this is balance. Price will not move or range in a certain space. When more people are willing to buy and there is less supply, no supply, price will rise. Okay, people are desperate to buy while there's not enough commodity to be sold. So price will be rise until somebody is willing to sell at a higher price. That will bring price higher when more demand injected into the market, and so price will go up. Very straightforward. Same thing on the opposite side. If there are less people willing to buy, or there's much more supply than people willing to buy, the people that are holding, participants that are holding the commodity will try to make a discount to get rid of the supply that they want to find sellers for. Price will go down until people will think this is a bargain price to buy, right? So the actual way to look at this, if we're going to look at a very old school of what a market is, what is the exchange, what happened at the exchange, just imagine these two piles of orders. On the right side, we have the sales orders that are represented by the lower pile of orders. This is the desk at the exchange, certain price for a certain commodity or stock or contract, whatever it is. On the right, on the left side, we have the buy orders, the orders that are looking to match sellers. On the right side, we have the sell orders, right? So what happened at the exchange at this point? We can see that each file here should have a matching file from the opposite side in order to make a deal, right? Somebody is looking for one file. The exchange will take one file from the sales order and they will match it to the buy orders pile, and then they will start making deals. As long as we have enough buyers and sellers, price is not going to change, and until the exchange will finally fulfill all the orders that are waiting there. But since in this illustration, we see that there are more buy orders than sell orders. So once all these orders of the seller side are being consumed, they are all being taken out and given to buyers. The remaining orders up there don't have any sellers to find. So what do you think will happen to price? At that time, there are no sellers in the market anymore. Okay, all sell orders were fulfilled. Okay, they were matched up with these buyers. The top pile, the top side of the pile, will not be fulfilled with sellers because there are no sellers at that price anymore, right? Now we'll go higher until we'll find more sellers to go. Right, price is increasing. So what happened? So our in the order flow supply and demand theory, we assume that at a specific price, let's say this illustration represents price $1.1 per a stock. Okay, so at that point where we match all sellers with buyers, price will go up now to 1.2, 1.3, etc., etc. However, we assume by the theory that these orders, unfulfilled orders, are waiting there at 1.1. Once price will return in the future to 1.1, these orders are waiting there to be executed to find new sellers. This is the theory assumption that we are going to rely on. So let's see how it looks on the chart. In terms of charting, we are going to refer to the balance area where we have enough buyers and sellers as base. And then we have rallies where price is going up and drops when price is dropping down, okay? So now we're going to just look at the market by seeing where price is rallying, where price is basing, and where price is dropping. So we have actually two broad terms. One is rally-based rally, which is a rally-based rally, which is a continuation. Okay, rally-based rally, or drop-based, drop-based. This is a continuation price action. And then we have also the reversal price action, which is rally-based drop, okay? Rally-based drop, or base drop, drop-based rally, okay? So that's a reversal to the upside, okay? So now we can look at these things, these areas in terms of order flow. I am really chewing up this for you so you understand how I read charts, and by doing this, you will have the ability to actually read naked charts with no indicators in it, practically understand the balance between buyers and sellers, and actually read a full narrative story of what happened between buyers and sellers, which are the most important actors on this scene, okay? Because we are, as a retail small traders, we can only try and hop on the wagon of the big participants. We cannot actually manipulate the market or do anything. We can just look what happened and join the action, right? So as a retail trader, it's very important for us to read a story from the market. So we start with the basics and try to see where we can see order flow remaining or order flow imbalance in the market, because once price return back to these areas, we assume that these remaining orders from the past will now be executed into our favor, and therefore we can have a good risk to reward or good risk management trade at these specific levels. So let's first do this, and once we get a hold on this drill, we can have much bigger picture on seeing motivations of the bigger players in the market. But you have to do the first steps on just doing the basics, okay? So let's just go through this chart and see what can we see with the naked eye in terms of order flow, okay? So at the beginning, we have a base and then price is rising up. So we have more demand than supply. Demand is represented, demand orders is, remember that pile here? So green are the buyers, red are the sellers, okay? So there are more greens than buyers, therefore price will rise up, right? Then now price is basing, okay? Rally, base, there, so we have a balanced amount of buyers and sellers. Then price is going up. What do you think the pattern will be? More buyers than sellers, more buying orders than sellers. Price will then base. So we have equal amount of buyers and sellers. Now, when we see prices dropping, we will see more sellers than buyers. So now, when you look at this, at these little graphics, just try to net position the orders, okay? Find the matching, match a green to a red one, and see what's remaining. The net order flow is now going to be 1 buyers versus 3 sellers. That's a net of 2 sellers remaining right here on this. So we know when price is going to come back in the future, that these 2 sellers are waiting here to be executed. So for sure, there is enough sellers right here because they are unfulfilled, okay? So now price drop and basing, so we find balance. And then price continue to drop, so more sellers than buyers. And again, now equivalent balance area, and price is rising up, so more buyers than seller, price is rising up, okay? Again, basing, so equal amount of buyers and sellers. Now price is dropping very, very fast, and so we have more sellers than buyers, right? So more sellers than buyers, we subtract the buyers from the sellers. We have 2 remaining sellers right here on the top. If we stretch that line, we can see a reaction right about there. Why? Because these remaining sellers are out there to be executed in the future. Okay, so again and again and again, you can go and do the same drill on yourself. See how easy it is to tell a story of the buyers and sellers in the market with a naked chart. no need for any indicators to tell us anything about anything, because we see where are the hot wired prices, where are the key levels right here. Just looking and seeing with a straightforward naked eye, we can see the balance between buyers and sellers, and where price had decided to drop, to make a rally or to make a drop. This is where at that point, at that decision point, and we'll talk about it in a moment, at that decision we want to put our trade in the future. So it's also for the sake of trading, it's very, very easy. We know on what price level we want to act in the future. So everything is very, very clear for us in that term. So very, very easy method. Okay. And also it really explains the market, right? Okay. So if you go and bother yourself to do this drill over and over, I think within 30 minutes or 1 hour of doing this practice for yourself, you will have the answer to what are the balance at any specific level. Okay. So Akash, you're asking how I draw it. Okay, so let's look at this situation. We see in the naked eye, we see with a very easy that price had made a decision to rally. Okay, price was going down, basing about here, and then it rallied. Where are the important levels of this pattern, of this trading pattern? Where do we think we are going to find the best area where we can assume for the highest certainty, again, not 100%, high certainty that there are remaining orders to be executed in the future? Let's find it out. Okay, so we have a drop, base, and rally. Right? We see price is going down, ranging for a while. Therefore, we have a balance area. And now we see an imbalance area right here. Okay, so let's find out the anatomy of what it is. So the very last trade, the very last deal was made at this extreme. Here we find the worst seller, the person that had sold with the least price. He just lost on this trade, and there is a lucky trader, a lucky buyer that actually bought at the very, very lowest price possible. Okay, this is one part of the pattern. Next, we have the last seller before the significant rally, right? So price was basing, then it was going up. We don't know exactly what is the order on this kind, if the low was before the high or how it closed, but we know for sure that with this candle, price had started to rise. And we see that this is the last dip before price was actually breaking higher levels and moving on forward. So this is a significant candle, and we can spot it with just a common sense, okay? No mathematics here, just common sense. So now we're going to look up for what would be the decision point for price to move on. Okay, so the decision point, if this is the dip and this is the close of this last candle, then breaking this close of the candle, breaking this is where we think that was the last time we had some sellers where this at this point, at this level, we had the last time sellers were in the game. So buyers won this rival right about here. We call this a decision point. And according to the illustration we did before with the balance icons, here we can figure out that there are more buyers than sellers, therefore there are remaining buy orders to break this and make this a significant candle. So this is the decision point, and this is where we would want to buy next time price will come. On the short side, we first mark the worst buyer and the best seller ever. This is the deal right there. And then we're going to look for the significant drop. Where does it start? This is all basing area. This is all bounce, but we see that from that candle, price had started the big drop. So this is the last dip before price had start making a significant move, right? So on this close, this will be our collective decision point. This is where we think price had to outwin the buyers with a lot of selling force, meaning that if we're going to imagine our icon again, we will see an icon with 3 red lines and maybe very a 1 or non green line, right? Okay, so the green pile is basically nets out and disappears. So we assume that at this level, we have a remaining sellers unsatisfied. With these remaining unsatisfied sellers, this is determine the very accurate price I would want to sell. Okay, so my sell will be at the decision price, the decision point. So let's take a look at how it goes. So on that Swissy chart that I showed you before, we see price is rallying, basing, and then starting to drop. It's starting to drop, and we see this significant candle. And because this is the significant candle, the decision point will be drawn on the close of the candle before. So we stretch, we decide that this price, whatever it is, it's just graphically, okay? We don't deal with numbers just yet. So this is where I would want to sell. And look what happened when I stretch it to the future, and just imagine that this is real time and prices dropping down, and now it's reversing, and now it's starting approaching up. Now it came to our decision point where we assume there are remaining sellers sell orders. We don't know how much. We just assume that the balance is leaning toward the sellers. Okay, this is all we know, nothing else than that. But for sure, because we see that price had made a significant starting from here. This is where we assume that sellers were not fully satisfied there are remaining sellers that could not find enough buyers, therefore price went down. Okay, so this is how understanding the balance between buyers and sellers at a specific level serves us in future in order to find a very powerful price levels. Okay, so why do I draw a square and not just a line? Because price was ranging before it made a decision, and this whole range is where I would price can penetrate anything anywhere on this particular zone. So price is not just one-dimensional entity. It has depth, it has range. There are a lot of arrays and pockets of supply and demand right here on the micro level. So so the whole price action area here is where I determine my risk. So if my entry would be at the decision point, my stop loss will be just above the price action zone. So this will determine my risk. So you see that with supply and demand analysis, we get almost the full trade plan just by drawing a supply and demand zone. Okay, not yet with the target, but we do have the entry, we do have the stop loss, right? So when price is approaching next time, and only on the first time, okay, for those who weren't here last week, next time on the very first visit and only on the first visit, because we don't have numbers, we don't have access to actual order, especially on Forex, but on CFDs, we usually don't have this information. So as long as we don't know these numbers, what is actually awaiting at the desk of the exchange, we can only assume a reaction. Also, it's important to understand, we can only assume a reaction, not a reversal, a reaction at the decision point or at the zone that it was only on the first visit. Okay, the next visit, we don't know anymore how much was actually consumed. Okay, so we'll have to use our theories to determine what happened if price will come here for the second time. Okay, so if you take the trade pattern I just described you, we do it only for the first approach, only for the first touch on a clear untouched level. Okay, so price is dropping and basing and dropping. Again, at this decision point, we have a remaining sellers that weren't fulfilled. They are waiting for price to come back. When price is visiting for the first time, okay, price is reacting. We see a reaction all the way down here, and from that, and then next time price is meeting the same level, it just penetrates through. Okay, this is just to show you that not all supply or demand levels will hold forever. Again, if price must be levels, and levels must be broken at one time. But we know for sure that at a specific time, at the very first time, if there is a pocket of unfulfilled orders, it will react. It will create a reaction in the market. So reaction can be just creating that bounce, that little retracement. Okay. So Kimberly asking about the selection of the time frame M15. Well, it's just to show you supply and demand works on all time frames. In fact, supply and demand is about, it's not about time frame, and time frame is just an arbitrary unit to draw candles. So there is no time for price. There are price levels. So because we have only this way to draw charts, we can drill from high time frame to low time frame, and this is the best view we can get and try to read the order flow. So it doesn't really matter what is the time frame. And you can see the same patterns all over on 1 minute or 1 week or 1 day or 1 hour or 4 hours, whatever. Okay, time frame doesn't matter. You can go on any time frame and see the same patterns over and over. Okay, now price is dropping, creating a base up here and deciding to drop. This decision to drop, this significant, this is our decision point. Above, this is the risk. When price is reaching up here for the first time, it doesn't really do anything significant. It's probably reacted by this one, so this one had canceled. This again to show you that we can only manage risk upon these levels, and these levels will be broken one time. Okay. Again, price is dropping, basing, and then dropping again. Decision point on the significant. So this is where we assume there are sellers. Next time price is coming, we have a reaction. The second time, the third time, it penetrates through, but not completely, not breaking, but only the fourth time it's breaking that level. So we have here 4 levels. One was just busted at the first time, not working. Just to show you, there's no 100% proof, but we see 3 out of 4 heads giving us the reaction. Okay, now price is going down again. We're not making it. Again, basing, drop. Next time price coming, we have a good reaction. Second times, we don't want to trade, although it creates a reaction, but we wouldn't take this as a trade. And then third time, a small reaction, and it just get through. Okay, so this is from the supply side. We have the same thing on the demand. On the demand, we have price dropping, basing, decision point right here, stop loss below the structure, and then once price is visiting for the first time, it consumes the demand orders here, and we can figure out that they are no longer. So we're taking our trade right here, and if we didn't, we cannot trade once price will get there back. So again, price is going up, basing, and here's a significant to go higher. So a decision point will be drawn right here. And then when price is coming and touching, punching a hole and spiking up, this is a reaction on lower time frame, but not holding for much long, but it is a reaction. Just to show you that when you are thinking in terms of order flow, you can explain all these what's so-called by other systems noise or uncertainty in the market with order flow. If we drill down to lower time frame, we can have an explanation why price had decided to stay here for a minute or for more, why price had spiked and then continue. We have all the answers if we describe the market by the terms of order flow, supply and demand. Okay, now price is basing, decision point, first time visit that had bounced up. So that already consumed our demand zone, but then price had reacted again for the second time, which is a very risky not to take, but just to show you that this level is wired. And then third time, it breaks. So we see when the levels are holding, and we see when levels are being broken, okay? Because this is the dynamic of the market. We go at the wall, we try to break it, we can't, but we made a dent or we made a crack, and then next time we hit that wall, we get through, okay? So this is the illustration for what is going on. We go to that certain level, we take all the buy orders here, there are no longer buyers here, and then next time price will come, there are no buyers here, so price will slide through. But at the first time, it did, okay? So price is a very price level or a key level or support and resistance levels are good for circumstances. They're not good always, okay? So it's really important to understand that level should be broken. Okay, so this is, again, rally, base, rally. We have here the decision point. When price is coming, it spikes very strong through, but we do have a reaction, although it would have taken our stop loss. So it's not a very accurate. This is, we've been busted and right at the same time. In terms of trade, we would be busted. In terms of analysis, we were right. Okay, so again, decision point right here, price came down, reacting on the very low of this structure, not giving enough points, but in terms of order flow, it makes sense, okay? So let's talk about breaking levels, because it's a very important thing to consider when you're making a trade. You cannot expect, like I show you, for a price level to continue working until it doesn't. And it doesn't make sense for you to buy or sell the same level over and over and over until you get your stop loss executed. Why not being smarter by trying to analyze the order flow balance on that area and what had happened with recent events at the same level, okay? So if we're looking at this supply area, a decision point, and price is dropping down, now it's approaching up. At the first time price was approaching, we had a reaction, and then at the third time, we had another reaction, not a very convincing one, because when we have this reaction, it didn't make any significant lows. What we would expect in terms of reversal is that when price is being hitting a packet of unfulfilled orders, if it was strong enough, that would have pushed price to break a demand level. If we were hitting a supply, we expect price to break a demand with that effort. But in this case, it didn't. So we don't want to sell or give it another try hitting here, because we see there is not a strong enough resistance waiting here. Maybe sellers will gather later on after this event and come and do something significant, but we don't have any hints for this. The only thing that we can read here is the reaction. We see that the reaction at where we were thinking there is enough sell force that it doesn't make any significant. It's all about effort versus result. If there is an effort to drop price, like we see here, but the result is not significant, it's not breaking anything, it's not breaking an opposite demand, we can assume now the balance of the powers is that there's not enough sellers in the market to break the demanding. So in the context of price coming up, it's maybe not a good idea to sell this area for the second time price goes here, okay? So, and we can see that price is going, and then the third time it's coming through. It does give a reaction, but and now it is convincing. It's breaking all these demands and being held on this demand right here. But now it's too late. We don't know anything about this area anymore. So this area is busted. It doesn't work anymore. And then when price is coming back to this zone, it just penetrates very easily through. Okay, so no longer this zone is valid for anything. Okay, then we have this supply again. Price is approaching. Next time it touches, we get the reaction, and then next time price is coming, we get another little reaction here. Next time it's easily slide through and bust our stop loss right above here. Okay. Here for the demand, drop based rally, and then price is coming back very, very soon. It reacts, give a good reaction. Next time, price is respecting, but much deeper, so you can see. Okay, this is not to take. This is not a trade to take because we had this reaction already. Okay, so and next time price is visiting, it consumes more of the demand packets that in here, and then next time price will break through this whole area. Okay, so this, whenever we look at the supply and demand, so the next layer of your work is to look if price had visited that area. So when price is not visited the area, we call it a fresh supply or a fresh demand zone. This is where it would be the best odds for you to take that trade. Next time price will visit, we don't know more about this, and we want to be and we should assume that price, when it's coming next time to the level, that some of these orders were already taken, and we don't know anything anymore about this zone, so we don't want to take it. I hope that's clear and makes sense. Okay, so so let's talk about the anatomy of breaking a level. Let's talk about this again by the language of order flow. So we have here 5 events on levels. Okay, we have drop base rally, and on that base we have a decision point. We call it event number 1, which is decision point. Then we have another base at the top, that's 2, and decision to break lower, so that will be a decision point to sell. And then price will go back for the first time on the demand level and react. That's number 3. And 4, price had come, made a reaction on these unfulfilled packet of sell orders, and then again, and then penetrate through. What is really happening in terms of supply and demand? Let's just illustrate this very easy. So what is the order flow balance between these two supply and demand parties in the market? So we see, because price on the decision point made a significant, we know that there are more people on the supply side willing to buy than, oh, sorry, that's really the opposite. It's a demand. Sorry, it's written on the just the opposite. I'm sorry for that. Okay, so green is the demand, red is supply, right? So there are more supply than demand. Just ignore whatever is written here. Just look at the colors. Okay, so more demand than supply. When we subtract, when we match the orders, there are leftovers of demand, right? Next time price will come. These demand orders are waiting to be executed and represent a buying power to the sellers that approaching to this level. Okay, now price is basing up there. And number 2, decision to break lower, meaning that there's more supply than demand. If we're going to match all the orders at this price level, we will be left out with unfulfilled sell orders, supply orders, right? And then next time when price approach to that specific price, these orders are waiting there. We know that there is a selling force on this level. Okay, this is to illustrate. Again, now price is coming. Remember, in the past, well, we had 3 supply and now 3 demand units, and price is approaching down. Now it's clearing, and price is rising up. Because it's rising up, we can assume that on this decision to pick up price, we have a demand left orders at this area. Okay, but now price is coming to this area for the next time, and it's balancing around this zone, and and because it's ranging, we can assume there's enough supply and enough demand. But then what happened is that this whole zone was broken. What happened at number 5? Number 5, suddenly an area that we were assuming that is a selling power zone, it was all consumed. All the sell orders were consumed, and price had decided to go up. This tells us that there are more buying participants, more buyers in the market than sellers. Therefore, once price is breaking this whole zone, this whole price action area, we assume that at this point where it broken that peak, we would have more demand than supply, right? Remember that these are written wrong, the opposite way. We have more demand than supply, therefore price rising up. But because it had to break a peak, because it had to break a price action right there, it had to leave it wasn't easy. it had to be fought for a while. So just think of this when you're drilling a wall and you put force, and you don't know how much more force you need to put when you're drilling that wall. And so you lean more and you bring more force, and suddenly it's snaps in, right? So you don't know and when it snaps in, you are crashed on the wall and maybe make a dent or something. It's because you didn't use um, the very accurate force that I had needed to punch that wall without hitting the wall. It's the same thing happening in the market. Nobody really knows what is against him, but if the party of buyers are strong enough, they are pushing and pushing, and sometimes they're pushing very hard and breaking this. And we don't know how many sellers been wiped out, and therefore we don't know how much buyers stayed here. But we know for sure that because price were up, we can assume with a great certainty that there are leftovers buy orders right here on the top. So this area, we call it a swap zone. Okay, we have a leftover of demand. This is the opposite, right? We have a leftover of demand right here on this area. And now this sell zone, which used to be red, is now becoming a buy zone on the top. Okay, so we call it a swap zone. Let's see how it works. So we have this sell zone, and once price had penetrated this, see how this area, all of a sudden, when the first visit from the top, it spikes up as a reaction to this zone because it's a swap zone. It used to be seller's power. To break it up, it created a buyer, it swapped a buyer zone, and we have now strong buying power or unfulfilled buying, and that creates a reaction. So eventually, price had penetrated a little bit lower, but then it's create a reaction. Okay, again, here we have this demand. When price had penetrated through, okay, it was a change from a demand into a supply. You see, when price is approaching from below, it's reacting as a selling power zone. So it's a swap zone, okay, again and again. A demand turn into supply from here. It's like the S shape, right? A supply broken, become a demand. Okay, so these are swap zones, and we can play them as our strategy. It's similar to a breakout strategy, but we are actually waiting for price to return to the breaking event, to the breaking scene. Okay, so this is wrap the theory for today. We can go over charts now, but before we do, let me read some question. Okay, Najwan is asking how we can identify the target price. So let's talk about this, although it's for the next lesson. Basically, what we're looking for is if we are if we're taking a buy on a demand, we would want to exit at the nearest supply we can see. It's very useful to maybe use two targets for a trade. One is immediate because we never know if a reaction turns out to be a reversal. So the first thing that we would want to target is the first opposite zone. If it's buying at demand, we would look for a supply. Let's take a chart and see what I mean. Okay. So let's take a, this is a ranging area. So let's this supply area happened here. And then before price had approached here, we have this decision point here, and we want to sell when price return to this level. Okay, it's 1.3244. We would want to sell right there. What? Okay. Now, what would be our target when price is hitting here? So we have price is dropping, creating a base, and we have another demand created to start the rally to go up. Then price hits our supply zone. We had sold here, and our target would be at the next demand. Okay, so sell from here. Let's just mark it. Sell from here all the way to demand. That would be our trade. Stop loss will be right above the structure. So that would have given us on 1 hour pound 132 pips while risking 30 pips. Okay, that is the case for here. Let's take another instance. We have if it's a counter trade trade, we have a base here, and price is coming up, and now price is hitting this, so this cancel this demand. So we have another right here. Price is coming, giving a very tiny reaction, and we're busted. Where our stop would be here. We've lost this trade. Then we have another base and a decision point right here. We drop this. Okay, so we would buy here. We get a reaction, and the next stop would be at this supply here, which price didn't reach there yet. Again, what is important to understand is that we also want to have the main context of the trend with us. Okay, so it's not we're not taking all the information from the chart like doing so. So it's not that technical. Here we have another base and rally. decision point right here. And our target would be at the decision point of supply, which price is on here. When we decide on TP, I usually use more conservative borders, the breaking of this week and not the breaking of the close. This is another way of drawing more conservative way for drawing zones. So on TP, I would take conservative price level usually. So that's where we would aim our target right here. So we would have risk here 44 pips and making 90. So it's almost 2 to 1. So you can practice this more and more. You should have the context of the trend, but again, decision point, price had made it. The next supply is right here, so let's react and go to supply, and so your trade would be from buying to sell on here, and your stop loss would be here. So that would be let's say 30 pips risk versus 50 pips profit. So this is how you time your target in a very non-brainer way. Use more discretion on this and try to go with the trend. Okay. Marlene is asking if we go with the trend context. Yes, if we want to buy the trend, so every time we make a lower low, there going to be some retracement where that retracement would be and where would we want to join the trend. That would be if it's a downtrend, that would be at the supply. Not always price is coming to supply, like at this area. Okay, price came to create a supply, gone back onto old demand, bounced to supply, that's okay. But then price was dropping down and coming up, never meet that supply again. So, but this will be a very intuitive way to trade and join into the trend. And then price is going down, going to this supply right here. So we would buy, we would sell to continue with the trend. We would exit for a while at this demand and then wait for price to counter trend and sell from here. We would better off trading with the trend. Yes. So trading with the trend is always a great idea. In the ranging area, then you can much easily determine your trades, buy and sell, sell and buy on the ranging area until it breaks into a certain direction. Rima is asking if we can use indicators to confirm after price action. I've mentioned this last time. Supply and demand is a reading theory. It's not. It can be used as a plain strategy, but it's also can be combined with any other strategy that you're already practicing. It just gives you another in-depth insight on the market and where it's going and where would be the key levels that we can expect reactions. So you can use supply and demand as another layer that will give you a better insight and better confirmation to whatever you do. And you can do also the opposite. You can use supply and demand as the key levels, and then at around key levels, you would apply your other system or your other knowledge and skills to confirm that what you want to see in the market. So you know that at around key levels, you would expect either a breakout or a ranging, a basing area, or a rejection or a reversal. So your other techniques can be the confirmation for what happened at key levels provided by supply and demand theory. So it's just another layer of information that you can apply on whatever you know already. So yes, Naresh mentioned fade outs and breakouts. Yes, we have a full lesson on this 3 weeks from now or 2 weeks from now. I don't remember what the schedule is, but we're going to talk in depth on the fake outs and breakouts. These are very powerful tools to work with, and it's a wonderful price action to understand the market. Actually, breakout and fake outs are just a good confirmation tools, and we can explain whatever happened on these area. We will set the anatomy of this price action event, and with that knowledge, you can actually use it in your favor, in your odds to trade. So make sure you sign up for the let's say another 2 lessons or 3 on this. Eugene, does any reversal qualify as decision zone? If so, does it mean that when the price reversed after touching a decision, it automatically creates a decision zone? Yes, exactly right. You can see right here. I don't know if anyone follows the question. So I will illustrate this. When price is approaching to, let's say, this supply, when it reacts to this supply, it creates a decision to break lower. That of itself is another supply. So Eugene have a great question that illustrates also how the market works. So as long as this pattern, price action area was not violating, was not breaking away, this is also a valid supply zone that was created by another supply zone. So we call these stacked zones, zones that are stacked on top on each other. The same thing we can see right here, a decision and the reaction to the decision actually create another decision and another decision. So this at itself being translated into a trend going down. So all these supply that were created as a reaction are also valid supply of themselves. So these are stacked supplies, free supplies for three different events on this downtrend. So good question. Okay, Marlene is asking a very technical question. Do you know what drives the quotes in our MT4 platform, Reuters, futures? How does our dealer in the Fiverr's feed for quotes? I always wonder about this as a Forex is so fragmented and the quotes can differ from dealer to dealer. Okay, so it's more about pricing technologies. The Forex is a distributed market. It happens on many different locations at once. So in order to create a pricing feed for Forex, there are agencies like Reuters, like Bloomberg, like many other liquidity providers that's specializing in, so most retail traders would not be familiar with their names. But these banks, what they do, they aggregate information that they're collecting from many banks all over the world, and they are aggregating all the deals into their database and creating a pricing quote. And then these aggregating raw information is being also aggregated with other agencies that creating the same thing, and then they are comparing these feeds and creating the price. Also, it's a very complex. It has a complex relationship between the banks, because the banks will make deals upon prices that these agencies are creating, because they are assumed to be reliable, and therefore the banks are using the feeds that they are actually creating. So it's a very complex mechanism. The reason why different brokers have different feed or different pricing, first of all, it's not that different. It's slightly, it's by pips or sometimes by the fragment of the pips, because most brokers today are connected to various feed agencies, so they can create an average price which is representing more correct pricing. And so there are changes. There are changes in the quantities, in the volumes, in the number of ticks, but in the overall, if you look at 5 pips range or 3 pips range on the US dollar, they are more or less the same. So this is because it's an undistributed, it's a non-centralized market. So price coming from various places, and these agencies are working very hard with very high-end technology to provide these, and they've created a benchmark that actually creates the pricing, and this is what we are being feeding our platform, whatever broker, whatever liquidity provider it is. Today, the service provider are so well balanced. In most cases, pricing are within a range of 3 pips correct. Does trading with supply and demand the best strategy? If so, then could we use Fibonacci with it to give good results or not? Like I said, I'm not saying supply and demand is better than anything else. I really like supply and demand because for me it gives me a lot of answers for why price behaves the way it is. It gives me a lot of reasoning. It gives me the trading structure. This is why I like supply and demand. It's all about the matching of my personality and my aspiration to understand the market. You can use Fibonacci, you can use whatever you think it works for you. You can combine, you can decide how much weight you give to each strategy. It's your own thing. Find your own combination. If it makes sense for you, then use it. If it's not, done. For me, Fibonacci is too arbitrary to use, so I don't use it. That's my opinion on Fibonacci. But for some people, it really makes sense. So why not? As long as you can make your goals with these tools. Joe, can you refer your question? When I trade, I get lost with previous supply and demand zones. How can I transition quickly to the next as trading is live? Well, I hope I understand your question, but let's look at cable real time at the end. Now, I don't think we really need to get lost. Now we're looking at H1 for the cable. So I would draw what I do. I would draw the zones that are clear and fresh. Okay. So here's a supply. Here's price approaching demand. Maybe it's already being touched. No, it didn't. Okay. So these are the nearest two levels I would like to consider. Okay. Now I see price is climbing up. I wouldn't want to sell versus this up situation. So I would think twice if I want to sell this. What would make me think I want to sell this? If I would see this demand, this supply, a reaction to an extreme level. What would be a good extreme? That would be a good extreme supply. This is a supply I would want to sell from. Why? Because this supply is a creation of this supply. In terms of order flow, what I can see here is that when price was reaching down, it had a good amount of force from the sellers, and then price had reject and create significant lower lows from that area. This at itself tells me that there is a significant seller's force that were all already making a significant lower lows. So before price will get up here, I don't want to sell. That would be more risky for me. But because I see prices building up, I would buy toward this area. So that would be a good entry point to take a buy, and I would try to go and sell at the conservative level of supply right about here on these lows, or on this, and maybe leave a portion to go all the way up here, because price can be rejected from anywhere if it wants to return to these to lower lows. Okay, so first target, safe target would be here, and we see here another supply right here. Now it's getting messy. It's about your question, right? Not having a messy chart. So so here's another drop rally, drop base drop, and so now price is not really reacting to any significant supply, so I wouldn't want to sell. So this supply is canceled. So this is how I eliminate, trying to make sense out of the story of the order flow. I want to see a reaction that made a significant result at the end, and this is what I would want to buy or sell. So this sell had made significant result. I want to sell it. This supply had made a significant result. It's the region of the whole thing that made a significant result. So I want to sell it. This supply haven't made anything. If price is reacted here, it's just a supply created for the sake of retracement and keep on. So this supply will be broken very easily. So again, we try to always assess what is this area is made of. And if the result was not significant, then we don't want to actually join this. There's not enough power, although it had some retracement. Why it made that change here? An explanation can be given by marking this stop and see what it was made of. So we can see that we had a demand that was broken, and now it's because it was broken, it is a supply. But now it's as a supply, it's used. Okay, so this whole area is nothing that we can be sure of what are the force balance in it. So we just leave it blank. So we want to buy from here, sell around here, and hope that it continue the downtrend. But now it's building up. So this is how I hope I answered your question. One last question: how to recognize the start of a trend or more and more demand or supply? Well, the good thing about supply and demand is that you don't have to guess anything. You can trade, and there's enough signals for you to trade after things had happened. If you look at the results of a reaction to a price level, if it's let's say if price went down and now it's reacting and breaking the supply that it was making, this can tell us that this trend is over, or it has a range until it will go to the next supply. So so now the next target is to get to the next supply before it goes. So there are enough room for this. If price will break down these supply and go up, we can say for sure that we are seeing a reversal. But then again, we don't really have to take it on a guessing. After it shows us it was it is the end of downtrend, then we can start picking up buying orders and go with a proven uptrend. Okay, as long as it's not proven, or if it's questioned trend, like situation, we would go to lower time frame, because on lower time frame now it's picking up, it's building up, so we can make a lower risk trades on a lower time frame, which are faster with faster targets, and it's all good. The same patterns will work. Or we can go to a very high time frame. Don't have enough information here. Sorry, but so with using with going to a higher time frame, we can see a bigger trend. But as much as the bigger trend, so is your risk. Your risk will be bigger, but your trend will be also bigger, and it takes longer. So it really depends on what you do and how you look, how you do the drill down. I think at this situation that price will reverse again, pick up from these lows and continue upward from this demand. Don't take my word for it, just for educational sake I was saying this, but this is how I would consider this. And then, of course, these would be my targets to buy or to enter shorts. Okay, guys, so we're 90 minutes in it, and so I really hope you gain some more information about supply and demand, and understanding how to think on levels and their tendency to break, when they will be broken, when they be reacting. Remember, a reaction is just a reaction. We don't know if it's going to be a reversal. Don't hope for reversal. Don't hope for big moves before the market shows you. When we read everything by the order flow mapping, like we did, and you be trained with this, you will find out that you can also know how to hold your trend longer in order to make more potential of it. But if we're taking it just as is, plain and simple and graphic, it's just between the zone that made it significant with the trend context, and the target will be the next opposite demand. That will be the safe target, and then we can leave some portion to run longer if we want to take it. So this is about no supply, no demand, when levels are going to hold or break. I urge you to practice this, go on demo charts and mark decision points, mark the top of the price action, then scroll to the right and see what were the consequences of the areas that you've marked and how much potential there was. When was that action at the reaction of the level that you've marked? was ending? Was it at the opposite zone? Was it at the zone that can be found on a different time frame? Look up for these things and try to read the charts by the order flow balance mechanism, and I think it's as easy as I show you. It makes sense. It's also the core mechanism that drive price up or down or range. So it cannot be. It's a mechanism that is universal and that is also timeless. And it is a really good tool for you to acquire, and you can combine it with any different strategy or use it as a standalone strategy, like I do. And this is as simple as it gets. We still have 3 more sessions about supply and demand, and we have much more patterns and ideas and theories to dive into. So make sure you sign up for the next 3 sessions. We're going to cover on fake outs, on breakouts, on different price action like compression, price action confirmation at key levels. So we'll have better odds. You will learn the simple fact that we don't need to jump on levels blindfolded, that we can have enough time to enter after we see a reaction. We can understand all the zigzags in the market if we're reading order flow. And so if you bear with us for the next 3 sessions, I think you'll be rewarded with good information that can give you some odds on your trading as well. So thank you so much for making it for today. And hopefully we'll see you next week, same hour, same day. Sign up and we'll see you next Tuesday. Thank you so much. Bye-bye.